Hello and welcome back to the channel. I'm Algabot, and on this channel we take real, working expert advisors for MetaTrader 5 and break them down line by line and candle by candle. Today we're looking at a strategy called Donchian Midline Reversion. It's a range trading, mean reversion approach that pairs the Donchian Channel with the Relative Strength Index, better known as RSI. By the end of this video you'll understand exactly how it spots a failed breakout, why it aims to trade back toward the middle of the range, and how its stops and targets are placed. Let's get into it. So what does this expert advisor actually do? At its heart, Donchian Midline Reversion is a mean reversion strategy. Instead of chasing breakouts, it does the opposite. It looks for breakouts that fail and then trades back toward the average price. The tool it uses to define the range is the Donchian Channel. That channel simply plots the highest high and the lowest low over a set number of bars, drawing an upper band, a lower band, and a midline running through the center. The default channel period here is 20 bars, and you can adjust it anywhere from 10 to 60. The core idea is straightforward. When price pushes outside the channel but then closes back inside, that's often a sign the breakout has run out of steam. Buyers or sellers tried to extend the move, couldn't hold it, and price got dragged back into the range. This strategy treats that failed push as an opportunity to trade back toward the midline, the middle of the range that price tends to revisit. To avoid acting on every little wiggle, the strategy adds two filters. First, it uses RSI to confirm that momentum is genuinely stretched, oversold for a potential long, overbought for a potential short. Second, it uses the average true range, or ATR, to measure how wide the channel is. If the channel is too narrow and compressed, the strategy simply stands aside because tight, flat ranges tend to whipsaw and produce noisy signals. The long and short sides are perfectly symmetric, the same logic, just mirrored. In terms of who this style might suit, it's aimed at traders who are curious about range-bound, counter-trend systems, and who want to study how a rules-based expert advisor defines its entries, stops, and targets. This is educational content designed to help you understand the mechanics. It is not financial advice. And, as always, trading carries real risk and losses do happen. Let's walk through the exact logic step by step. The strategy works on completed bars, so it only evaluates once each new bar closes. When a fresh bar closes, it becomes what the code calls the signal bar. First, the strategy builds the Donchian channel. Importantly, it measures the highest high and lowest low from the bars just before the signal bar, not including the signal bar itself. That matters, because it means the signal bar's own spike outside the channel doesn't move the band it's being compared against. From that upper and lower band, the midline is simply the halfway point between them. Next comes the width filter. The strategy measures the distance between the upper and lower bands and compares it to the average true range multiplied by the MinWidthAtr setting, which defaults to 2. If the channel is narrower than that, the range is considered too compressed, and the strategy passes on the trade entirely. This keeps it out of dead, flat conditions. Now the entry conditions. For a long, 3 things must all be true on the signal bar. The bar's low must dip below the lower band. The bar's close must finish back above the lower band, inside the channel. And the RSI must be below the oversold level, which defaults to 30. Together, that describes a failed downside breakout with stretched momentum. The short side is the exact mirror. The bar's high must poke above the upper band. The close must finish back below it inside the channel. And the RSI must be above the overbought level, which is calculated as 100 minus the oversold setting, so 70 by default. Now the exits. For a long, the stop loss is placed just below the signal bar's low, cushioned by the ATR multiplied by the stop multiplier, which defaults to 1. The take profit is the channel midline. For a short, it's mirrored. The stop sits just above the signal bar's high plus that ATR buffer, and the target is again the midline. Before sending any order, the strategy checks that the midline actually sits beyond the entry, so there's genuine room to travel. And it only ever holds one position per symbol at a time, so it won't stack trades on top of each other. Here's the heart of the strategy in MQL5, styled as you'd see it in MinWidthAtr. At the top are the input parameters you can tune. ChannelPeriod sets how many bars define the Donchian channel. RsiPeriod and RsiOversold control the momentum filter. Note the overbought level is simply 100 minus the oversold value. ATR period feeds the volatility calculation, MinWidthAtr sets the minimum channel width, and RsiOversold multiple controls how far the stop sits beyond the extreme. Lots is the trade volume, and magic tags the strategy's own positions. Now look at the two signal lines. The long signal is true when the signal bar's low dips below the lower band. Its close finishes back above that lower band, and RSI is below the oversold level. The short signal is the exact mirror. The high pokes above the upper band, the close settles back below it, and RSI is above the overbought level. When the long condition is met, the code reads the ask price as the entry, sets the stop just below the signal bar's low minus the ATR buffer, and sets the take profit to the channel midline. It then checks there's room toward that target before calling trade.buy. The short side does the same in reverse. It uses the bid price, places the stop just above the signal bar's high plus the ATR buffer, targets the midline, and calls trade.sell. Same structure, both directions, defined risk on every order. Let's bring the whole strategy to life on a chart. On screen you can see price candles with the Donchian channel drawn over them, an upper band, a lower band, and the midline running through the center. Below the price is the RSI, with its oversold level at 30 and its overbought level at 70 marked as dashed lines. Watch how the two work together. We start with price sitting inside the channel, drifting gently lower over the first few candles. As it falls, notice the RSI on the lower panel sliding down toward that 30 line. Momentum is cooling as sellers push price toward the lower edge of the range. By the fourth and fifth candles, price is pressing right against the lower band, and the RSI has slipped into the oversold zone beneath 30. Then comes the key candle. Price dips below the lower band, printing a fresh low outside the channel. At first glance, that looks like a downside breakout. But by the close, price has climbed back up and finished inside the channel again. That's the failed breakout. This strategy is built to fade. The bar pierced the band. Sellers couldn't hold the new low, and buyers dragged the close back inside. With the RSI confirming an oversold reading below 30, every condition lines up, and the buy entry marker appears on that candle. Now look at where the protective stop sits, just below that rejected low, cushioned by a multiple of the ATR, so the trade carries a defined risk from the very start. The take profit target is the channel midline, up in the middle of the range. The strategy isn't reaching for the far side of the channel. It simply aims for the average, the midpoint the range keeps returning to. Over the next few candles, price does exactly that. It lifts off the lower band. The RSI climbs back toward the middle of its range, and the candles step upward until price touches the midline. There, the take profit target is met and the long position closes. A clean fade of a false break, aiming for the middle of the range. But price doesn't stall at the midline this time. Momentum carries it higher, up toward the top of the channel. Watch the RSI now. It's climbing past 50, past 60, heading for that 70 line. Price pushes into the upper band and, on the signal candle, spikes above it, printing a high outside the channel. Once again it looks like a breakout, this time to the upside. And once again it fails. By the close, price has dropped back inside the channel. The RSI is pushed above 70 into the overbought zone, and the mirror image condition is complete. The sell entry marker appears. This is the fully symmetric short side. The stop is placed just above the rejected high, ATR buffered, and the target is once more the midline. Over the following candles, price rolls over. The RSI eases back down out of overbought, and the market drifts toward the center of the range until the midline is tagged and the short take profit is met. So in one sequence you've seen both halves of the strategy, a false break below the lower band with an oversold RSI that fades back up to the midline, and a false break above the upper band with an overbought RSI that fades back down to the midline. Same logic, mirrored, always aiming for the middle of the range. And that's Donchian Midline Reversion from top to bottom. We covered how it uses the Donchian channel to define a range, how it fades failed breakouts back toward the midline, and how RSI and the ATR with filter work together to screen those signals. We walked through the exact entry and exit rules, read the core MQL5 code for both the long and short sides, and trace 2 example trades on the chart. Remember, everything here is for educational purposes only. It's information to help you understand how this expert advisor works, not financial advice or a recommendation to trade. If you found this breakdown helpful, please like the video, subscribe for more MT5 strategy analyses, and drop a comment with any strategy you'd like us to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.